As an investor, if you've been monitoring your stock portfolio lately, 2022 may seem like a terrible year. To say that the stock market's been stuck in a rut would be an understatement. The S&P 500 has fallen almost 27% since the beginning of the year, putting it firmly in bear market territory. The Russia-Ukraine war, crazy inflation, and post-COVID supply shortages have played their part in the stock market crash. But the number one threat looming over the market is none other than the Federal Reserve. Struggling to cope with inflation, the Federal Reserve has recently announced a 0.75% rate hike, bringing the lending rate to a target range of 3.75 to 4%, the highest level since January 2008. This, along with Federal Chairman Jerome Powell's comments that the rates would likely end up higher than the Fed originally anticipated, have resulted in a further decline in stock markets. And if that's not enough, research from the Bank of America shows that the stock market is likely to fall further into 2023. Now, while it's tough to watch your investment returns go down further and further as months go by, a dip in the stock market's not necessarily a bad thing. In fact, market volatility and uncertainty have helped many savvy investors build their fortunes and leave lasting legacies. But how do they do it, you ask? Well, keep watching this video to learn how a stock market crash can be a fantastic opportunity for investors to be strategic and take advantage of high-quality stocks to build their wealth. But before we proceed, if you've enjoyed the video so far, do consider subscribing to our channel ATLAM, where we discuss all things life and money. We are constantly working to upload such informative and educational videos to help you guys better your lives. Number 1. Resist the urge to sell in a panic. As an investor, you should be investing for the long term and should only consider selling when the price of your stock is high. But when your portfolio experiences a down market, it becomes tough to watch your investments go down in value day after day. Fear starts to creep in, and you tend to panic and have the natural reaction to take some action, to try to regain control of the situation. Most likely, you consider selling off your stocks to limit further loss of your investments. It may seem like a good idea at the time, but in reality, all you've done is confirmed your loss. The classic investment strategy to buy low and sell high goes out of the window, and you end up doing the exact opposite as your decisions are driven by your emotions, which can be detrimental to your long-term plans. So, first and foremost, the best course of action you can take is to simply do nothing. Don't panic and resist the urge to sell. If you ignore the dips and continue to remain invested, technically you will not lose a dime. For example, let's say your portfolio takes a hit and goes from $200,000 to $150,000. You haven't lost $50,000 unless you sell off your stocks. Your investments can still rise once the economy recovers. The loss is just on paper. So rather than panicking and selling off your stocks, it's better to ride out the storm by keeping two things in mind. It's not a loss until you sell. And historically, the market always recovers after a crash. Number 2, diversification. I think we can all agree that markets are unpredictable. Even the most seasoned experts can only speculate, and no one with absolute certainty can predict the market's peak or bottom. And for that very reason, it's always better if all your investments aren't concentrated in one type of financial asset. In fact, there's even a famous quote by Warren Buffett: "Do not put all your eggs in one basket." The basic idea behind it is that if one of your assets is going through a downturn, your other asset can minimize the impact of those losses. So if you haven't been diversifying, then start today by building a strong and more diversified portfolio by making investments in different types of assets. Stocks, real estate, bonds, ETFs, business, derivatives, precious metals. They're just some of the assets that are available to investors. You can also further diversify your stock portfolio by including defensive stocks. These stocks include categories like consumer staples, which are always needed regardless of the economic situation. All in all, diversification is a prudent long-term strategy, even if it doesn't guarantee protection against losses. Number 3, buy more stocks. By now, you must have heard this quite a few times that a stock market crash provides you with an opportunity like no other to build wealth. But what exactly do you need to do to capitalize on the situation? Well, all you need to do is follow the fundamental rule of investment. That is, buy low and sell high. The downturn market is the perfect time to practice this rule, as all the stock prices are down and you can buy some really high-quality stocks at discounted prices. You could consider this like a Black Friday sale for buying assets. The more stocks you buy at discounted rates, the more profit you can accumulate once the market goes back to normal. Many astute investors in the past have become millionaires by buying stocks at a bargain during the previous crash of 2008, or dot-com bubble burst, and the current crash could very well be your ticket to become a millionaire. Of course, just because the stock is available at low prices doesn't mean you end up buying any stock regardless of its reputation before the bear market. You need to do your due diligence and find strong companies with healthy margins and strong cash flows, as they're most likely to recover first. Ideally, it would be better to focus on quality blue chip companies which are well established with strong balance sheets. Also, it's important to remember that trying to time the market is a fool's errand. Even expert investment managers who spend their careers studying the market find it impossible to predict when stock price will be at its lowest. So the most effective way to buy stocks, especially during a bear market, is through dollar cost averaging method, wherein you can contribute a fixed amount, could be $100 or $500, at regular intervals, like a monthly basis, and accordingly reduce the impact of market volatility on your stock portfolio. Now, if you want to learn more about dollar cost averaging method, or investment in defensive stocks, or how to invest in other assets during a crash, do check out our video in the link below. Number 4, focus on dividend stocks. When the economy is booming, everyone focuses on growth stocks. But during an economic downturn, these stocks usually suffer the most. The reason for this is because their valuation isn't backed up by strong fundamentals. Simply put, they're overvalued and the stock's price could decline further. Now, while stock prices are dictated by buying and selling in the stock market, a dividend typically comes from a company's net income. Even if the stock price decreases, but the company is performing well and earning profit, they can pay dividends, and accordingly, finding dividend-paying stocks at a time like this can be a smart move for any investor. Not only are you buying stocks at a bargain, but you're also getting some additional earnings. Now, although dividends aren't guaranteed and can vary depending on the performance, companies that issue dividends tend to be more stable and their stock prices are less volatile. Plus, as long as you're receiving dividends, there's always some gains. Accordingly, it'd be wise to invest in dividend stocks during a bear market when the share prices and returns are in decline. Number 5, focus on the long term. Research has shown that stocks always outperform any other asset class over the long term. Even if you look at the historical price charts, you'll find that even the biggest dips look nothing more than a mere blip in the market's long-term upward trend. In fact, those markets have always recovered to grow higher than ever before. So, rather than worrying about short-term fluctuations, especially during a volatile market, it's better to remain disciplined and continue to invest by doing sound research to achieve your long-term financial goals. And this principle is only further validated by legendary billionaire Warren Buffett through his famous quote, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Lastly, a bonus tip. It's always recommended automating your investments. It will help you take advantage of that dollar cost averaging, and it'll save you from the lost opportunity of trying to time the market. Always remember, time in the market is more important than timing the market. If you found today's video informative and helpful, do subscribe to our channel for more content like this. Thank you for watching, and we hope you guys have a lovely day.